Hello and welcome to our news video. Subscribe to our channel and share your comments so that you don't miss any important news. North Carolina's HB 92 bill, a groundbreaking step toward strategic Bitcoin reserves. SEC poised to acknowledge XRP and Dogecoin ETF filings this week, experts say. Ethereum's role in Web3 expansion. How L2 rollups and the superchain are shaping the future. Barricane under fire, airdrop controversy and insider dumping spark 63% price plunge. 2024 crypto VC landscape, deal count drops 46% from Q1 to Q4 while investment volume bounces back. North Carolina's HB 92 bill, a groundbreaking step toward strategic Bitcoin reserves. North Carolina has recently emerged as a trailblazer among U.S. states seeking to integrate digital currencies into their financial strategies. With the introduction of HB 92, the state is making a decisive move to enable investments in Bitcoin and other digital assets as part of its strategic reserves. This legislative effort is being hailed by industry experts as more than a symbolic gesture. It is a concrete plan with significant implications for state-managed funds and the broader adoption of digital currencies. A bold legislative initiative. HB 92 represents a comprehensive approach by North Carolina lawmakers to diversify the state's investment portfolio. Under the provisions of the bill, up to 10% of the state's funds may be allocated to exchange-traded products that are linked to digital assets. However, there is an important caveat. These digital assets must be associated with a market capitalization of more than $750 billion. This criterion ensures that only highly liquid and established cryptocurrencies, such as Bitcoin, are considered for the state's strategic reserve. The bill goes beyond mere speculative investment. It provides for the inclusion of Bitcoin in various state-managed funds. These funds include those dedicated to teachers and state employees' pensions, insurance funds, and even veterans' home trust funds. By allowing such allocations, North Carolina is setting a precedent for how public funds can be leveraged to tap into the burgeoning world of digital assets without compromising fiscal responsibility. Unique leadership and industry support. What distinguishes North Carolina's HB 92 from similar proposals introduced in over a dozen states is the caliber of its leadership and the level of stakeholder alignment behind it. The bill was spearheaded by Representative Destin Hall, the Speaker of the North Carolina House of Representatives, whose influential status in the state legislature lends considerable weight to the initiative. Hall's leadership has been instrumental in framing HB 92 as not only a forward-thinking measure but also as a necessary adaptation to the evolving financial landscape. Co-sponsorship from seasoned legislators such as Representatives Mark Brody and Steve Ross, both recognized as steadfast Bitcoin advocates, further reinforces the bill's credibility. Their long-standing support for digital asset initiatives underscores a shared belief that integrating cryptocurrencies into state funds is a strategic move that could yield long-term benefits for North Carolina's financial management. Dan Spuller, head of industry affairs at the Blockchain Association, has been a vocal proponent of HB 92. In a series of posts on social media, Spuller detailed his advisory role in guiding North Carolina officials through the intricacies of the proposed legislation. He emphasized that this initiative is not just about messaging, it is a robust plan actively moving forward, with the right stakeholders on board to ensure its successful implementation. A part of a nationwide trend. North Carolina's push for a strategic Bitcoin reserve is part of a larger national trend, where more than a dozen states have introduced similar legislation. However, industry observers note that HB 92 stands out due to its comprehensive scope and the practical measures it envisions. While many states are merely exploring the concept of digital currencies within their fiscal frameworks, North Carolina's bill is designed to have an immediate and measurable impact on state investments. The bill's framework allows the state to potentially benefit from the significant growth that digital assets have experienced in recent years. Bitcoin, for instance, has not only become a household name but also a key asset in the portfolios of various institutional investors. With market capitalizations soaring and increased interest from both private and public sectors, digital assets offer a compelling opportunity for states to diversify their revenue streams and hedge against traditional market volatility. Economic implications and future prospects. The potential economic benefits of HB 92 are substantial. By permitting a controlled and regulated exposure to Bitcoin and other digital assets, North Carolina could enhance the performance of its state-managed funds. This move may also encourage other states to adopt similar measures, thereby setting new standards for public financial management in the digital age. The bill reflects a growing recognition that blockchain technology and digital currencies are not fleeting trends, but rather transformative elements that can contribute to long-term fiscal stability and growth. Moreover, the Strategic Reserve Initiative positions North Carolina as a leader in the innovative integration of technology and public finance. As digital asset markets continue to mature, with developments such as increased institutional adoption, the launch of spot Bitcoin ETFs, and favorable regulatory shifts, the state's proactive stance could serve as a model for other regions. The synergy between advanced financial instruments and robust regulatory frameworks may well redefine how public funds are managed in the future. SEC poised to acknowledge XRP and Dogecoin ETF filings this week, experts say. The U.S. Securities and Exchange Commission, SEC, appears set to acknowledge spot exchange-traded fund, ETF, filings for XRP and Dogecoin as soon as this week, according to leading industry experts. This potential move follows the SEC's recent notable action in acknowledging an amended Solana ETF application submitted by Grayscale on February 6, a decision that has set the stage for what could be a flurry of activity in the digital asset space. Growing momentum in crypto ETF filings. Bloomberg ETF analyst James Seifert, together with his colleague Eric Balchuners, have been closely monitoring the SEC's handling of crypto-related filings. Their latest assessments indicate that the agency may soon give its nod to ETF filings for both XRP and Dogecoin. While the agency's prior acknowledgement of the Solana ETF application was a significant milestone, these experts now estimate that the odds of approving a spot ETF for cryptocurrencies are rapidly improving. Seifert has pointed out in a post on X, formerly Twitter, dated February 10 that the applications for spot ETFs on Ripple's XRP and the renowned meme coin Dogecoin could receive official acknowledgement by the end of the week. This optimistic outlook comes on the heels of the SEC's progress with other digital asset filings. In particular, the agency has already acknowledged Form 19B for submissions for both Litecoin, LTC, and Solana, SOL, ETFs. Current expectations from Seifert and Balchuners suggest that the approval odds for a spot Litecoin ETF stand at an impressive 90%, while the Solana ETF approval is estimated at around 70%. With final deadlines for these filings set for October 2nd for Litecoin and October 25th for Solana, the countdown is well underway, underscoring the SEC's increasingly proactive stance in this burgeoning sector. Detailed outlook for XRP and Dogecoin ETFs. The landscape for crypto ETF filings is rapidly evolving, and the latest developments are drawing considerable attention from investors and regulators alike. CBOE-BZX has been active in this arena, filing S-1 forms for XRP ETFs on behalf of major players such as Canary Capital, WisdomTree, 21 Shares, and Bitwise. Simultaneously, filings for Dogecoin ETFs have been submitted by both Grayscale and Bitwise. Analysts now predict that the SEC could acknowledge these Form 19B for filings for XRP and Dogecoin ETFs on February the 13th and 14th, respectively. The timely acknowledgement of these filings is expected to pave the way for further regulatory clarity, thereby increasing investor confidence in the cryptocurrency market. The anticipated SEC action is particularly noteworthy given the broader market sentiment in the post-Gary Gensler era. The evolving regulatory landscape has created an environment where digital asset investment vehicles are not only gaining legitimacy but are also being seen as essential instruments for portfolio diversification. Seifert and Balchuners have updated their forecasts, placing the odds of obtaining final approval for XRP and Dogecoin ETFs at approximately 65% and 70%, respectively. Such figures underscore the SEC's gradual shift towards a more accommodating approach for digital asset products, which could ultimately lead to enhanced market liquidity and investor protection. Regulatory clarity on the horizon. Beyond the immediate acknowledgements of ETF filings, experts believe that the SEC and its associated crypto task force, chaired by Commissioner Hester Peirce, will soon deliver long-awaited regulatory clarity. One of the key challenges that remains is the untangling of the question of whether certain digital assets should be classified as securities or commodities. Achieving this clarity is seen as critical for the sustained growth and legitimacy of the cryptocurrency market, and many anticipate that the task force's recommendations could be finalized by the end of 2025. This regulatory evolution is expected to provide a clear pathway for the approval of digital asset ETFs and to facilitate more robust investor protections in an increasingly complex market. Implications for the crypto market and investors. The potential SEC acknowledgement of XRP and Dogecoin ETF filings carries significant implications for the broader cryptocurrency market. For investors, the move could signal an important shift towards mainstream acceptance of digital assets, leading to increased market participation and potentially greater price stability. Furthermore, the likelihood of additional approvals, combined with the successful acknowledgement of other crypto-related filings, may serve as a catalyst for further institutional investment in cryptocurrencies. As the SEC's regulatory framework evolves, market participants could benefit from a more transparent and predictable investment environment. The proactive steps taken by the SEC in recent months are indicative of a broader trend towards integrating digital asset products into traditional financial markets. With increasing institutional interest and the continued push from industry experts for more favorable regulatory treatment, the forthcoming acknowledgement of XRP and Dogecoin ETF filings might be just the beginning of a new era in crypto investment. The anticipated decisions will not only impact the short-term market dynamics but are also expected to influence the long-term development of digital asset investment vehicles across the United States. Ethereum's role in Web3 expansion, how L2 rollups and the superchain are shaping the future. Ethereum continues to stand at the forefront of Web3 innovation, serving as the backbone of decentralized applications. With the emergence of Layer 2, L2, rollups and the expansion of the superchain, Ethereum's influence is set to grow even further, solidifying its status as the most trusted blockchain for settlement, scalability, and interoperability. Ethereum's unmatched position in Web3 development. Speculation surrounding Ethereum's displacement in the blockchain space has been ongoing for years. Yet, Ethereum remains the leading smart contract platform, outpacing competitors such as Solana in key metrics like total value locked, TVL, a crucial indicator of user confidence in a network. While alternative blockchains continue to innovate, Ethereum's enduring strength lies in its extensive ecosystem and compatibility with the Ethereum Virtual Machine, EVM, which remains the industry standard for smart contract execution. As Ethereum nears its 10-year milestone, it has not only weathered market fluctuations but has also continued to enhance its capabilities through a roadmap that prioritizes scalability, security, and decentralization. A significant milestone in this evolution has been the integration of Layer 2 rollups, which offer solutions to Ethereum's historical scalability challenges, allowing for reduced transaction costs and increased throughput. The superchain, a new era for Ethereum scalability. Ethereum's robustness extends beyond its mainnet, thanks to a growing network of L2 rollups that contribute to its overarching expansion. One of the most impactful developments in recent years has been the formation of the superchain, a collective of L2 networks built using Optimism's OP stack. These L2 solutions are not only enhancing Ethereum's scalability but are also reinforcing its role as the primary settlement layer for Web3 applications. Major blockchain projects and corporate entities have recognized the potential of L2 rollups, opting to build on top of Ethereum rather than launching independent Layer 1 networks. Some of the most notable platforms that have joined the superchain include Coinbase, a prominent L2 chain focusing on retail adoption and institutional use cases. WorldCoin, a project designed to enhance decentralized identity solutions. Kraken, a crypto exchange-backed chain emphasizing financial applications. Sony, a blockchain network exploring metaverse and entertainment use cases. Uniswap, a DeFi-centric L2 developed by the leading decentralized exchange. The combined transaction volume of the superchain has already surpassed expectations, with over 47% of all Ethereum L2 transactions originating from this ecosystem. As more chains with established user bases integrate into this collective, Ethereum's position as the foundational blockchain of Web3 is expected to strengthen. Ethereum's role in Web3 expansion and market adoption. With Ethereum's L2 fees now averaging below 1 cent, new opportunities are emerging across multiple industries. Lower transaction costs are making Ethereum-based solutions more accessible to users in emerging markets, where blockchain adoption is growing at an accelerated rate. Among the key areas where Ethereum is expected to thrive are stablecoins, decentralized finance, DeFi, and Web3 gaming. Stablecoins and emerging markets. Stablecoins have been a driving force behind blockchain adoption, particularly in regions where access to stable financial infrastructure is limited. Historically, Ethereum's high network fees have made it less competitive compared to cost-effective alternatives such as Binance Smart Chain and Tron. However, with L2 rollups now significantly reducing costs, Ethereum is regaining its competitive edge, positioning itself as a preferred network for stablecoin transactions, remittances, and digital payments. Decentralized finance, DeFi, dominance. Ethereum has long been the dominant blockchain for DeFi applications, holding over 60% of the total value locked, TVL, in the sector. The expansion of L2 solutions has further reinforced Ethereum's lead, as users seeking low-fee, high-efficiency DeFi services increasingly migrate to Ethereum-based platforms. A prime example of this trend is Base, an Ethereum L2 that saw a 370% surge in TVL to $2.28 billion in 2024, largely due to its appeal among DeFi users. This shift suggests that Ethereum will continue to serve as the primary hub for decentralized financial services, even as competition in the space intensifies. Web3 gaming and chain consolidation. Beyond DeFi, Ethereum's scalability improvements are attracting new sectors, particularly Web3 gaming and consumer applications. As gaming projects seek more scalable and cost-efficient blockchain environments, Ethereum L2s are becoming the preferred infrastructure due to their enhanced security, guarantees and developer support. The Ethereum ecosystem benefits from a highly skilled community of infrastructure developers, whose collaborative efforts continue to refine user experience across L2 rollups. This ongoing innovation is expected to drive further adoption, gradually shifting market share away from competing chains and consolidating Ethereum's dominance. Looking ahead, Ethereum's continued growth in Web3. The convergence of L2 rollups, superchain adoption, and increasing institutional participation paints a promising picture for Ethereum's future. The blockchain's role as the primary settlement layer for decentralized applications is becoming more pronounced, particularly as interoperability between L2s improves. As Ethereum-based solutions continue expanding into key markets, its influence over Web3 development is set to grow even stronger. Barricade under fire, airdrop controversy and insider dumping spark 63% price plunge. Barricade, one of the most anticipated Layer 1 blockchains, is now facing intense backlash as its proof of liquidity model comes under scrutiny. Launched on February 6, the project initially captivated the crypto community with ambitious plans and one of the largest airdrops of the year. However, recent events, including concerns over airdrop allocations and allegations of insider dumping, have led to a dramatic 63% decline in its native token's price from its launch high. A promising launch marred by controversy. Barricade's journey began with great fanfare, fueled by its origins in the Bong Bears NFT collection, a cannabis-themed project that first emerged in 2021. The transition from an NFT project to a full-fledged blockchain platform was marked by an innovative proof of liquidity mechanism, which was designed to incentivize participation and liquidity provision within the ecosystem. Major cryptocurrency exchanges such as Binance, MEXC, Upbit, and Bithum quickly listed Barricade's token, BARA, amplifying excitement and expectations among investors. In the days following its launch, Barricade experienced a surge in adoption. By February 11, the project had amassed a total value locked, TVL, of $3.1 billion, making it one of the most talked about blockchain launches in recent memory. Despite these promising indicators, the initial excitement soon gave way to significant concerns regarding the project's tokenomics and distribution model. Concerns over airdrop allocations and tokenomics. Central to the controversy is Barricade's airdrop distribution, which has left many participants feeling shortchanged. Users who took part in the testnet phase reported receiving far fewer bearer tokens than anticipated, igniting frustration and disappointment across social media channels and crypto forums. This sentiment has been further compounded by emerging data that points to systemic issues within Barricane's token structure. At the core of the platform's economy are three interlinked tokens: Bearer, BGT, and Honey. Each token is intended to serve a distinct role within the ecosystem. However, critics have raised alarms over the possibility that early investors and insiders might be exploiting the system. It appears that private investors, holding more than 35% of the total bearer supply, can stake bearer to earn BGT, subsequently burn BGT to acquire additional bearer, and then sell these tokens on the market. This cycle creates a potential loophole, allowing early backers to extract liquidity at the expense of retail investors. A frustrated trader encapsulated the community's outrage when commenting, "Wait, so insiders can cycle through the token mechanics and dump on retail. This can't be real." Such observations have only intensified the debate over whether Barricane's innovative model is being undermined by practices that favor insiders over ordinary users. Insider selling and market reaction. The controversy deepened further when reports emerged of insider selling. Notably, one of Barricane's key developers, known by the pseudonym DevBear, reportedly received 200,000 bearer tokens as part of the airdrop. Within a short period after the mainnet launch, DevBear began selling portions of these tokens. This move has not only stoked suspicions about potential conflicts of interest but also contributed to the mounting selling pressure on bearer. The impact of these actions was swift and severe. On its launch day, bearer reached a high of $14.99. However, by February 11, following widespread concerns over tokenomics and insider dumping, the token's price had plummeted to $5.57, a staggering 63% drop. While volatility is a common characteristic among newly launched cryptocurrencies, the rapid decline in bearer's value has raised critical questions about the sustainability of Barricane's initial hype and the inherent fairness of its token distribution mechanism. The broader implications for the crypto ecosystem. The unfolding situation at Barricane has sent ripples through the broader crypto market, highlighting the challenges that innovative projects face when balancing groundbreaking token models with investor protection. As asset managers and blockchain developers race to implement novel mechanisms, the case of Barricane serves as a cautionary tale about the potential pitfalls of poorly structured tokenomics. Industry experts are now calling for a closer examination of incentive structures within new blockchain projects. The concerns raised by Barricane's community could prompt regulatory bodies and independent auditors to scrutinize the practices of early investors and insiders more rigorously. The goal, many suggest, should be to ensure that innovative financial mechanisms do not disproportionately benefit a select few at the expense of the broader investor base. For retail investors, the controversy surrounding Barricane underscores the importance of thorough due diligence before participating in new projects. The rapid price decline experienced by bearer serves as a stark reminder that even highly anticipated and innovative blockchain launches can harbor underlying risks that may not be immediately apparent. Looking ahead, can Barricane recover? As Barricane grapples with these controversies, the future of the project remains uncertain. Proponents of the platform argue that the initial volatility is part and parcel of the early stages of blockchain innovation and that corrective measures, such as refined token distribution practices and enhanced transparency, could restore confidence over time. However, critics remain skeptical, questioning whether the current tokenomics structure is fundamentally flawed and overly advantageous to insiders. The coming weeks and months will be crucial for Dogecoin. The project's leadership faces mounting pressure to address the concerns of disgruntled investors and to demonstrate that its proof of liquidity model can deliver on its promise without compromising fairness. In the highly competitive landscape of Layer 1 blockchains, the ability to navigate such challenges will be pivotal in determining Dogecoin's long-term viability. 2024 Crypto VC Landscape. Deal count drops 46% from Q1 to Q4 while investment volume bounces back. According to the latest data from PitchBook, the cryptocurrency venture capital space experienced a notable shift in 2024. While the number of crypto VC deals fell sharply from 653 in the first quarter to 351 in the fourth quarter, a 46% decline, the total investment value rebounded in Q4, indicating that investors are increasingly focusing on selective, high-value projects. Shifting dynamics in deal count and investment volume. PitchBook's Crypto VC Trends report reveals that the overall deal count in the crypto sector witnessed a significant quarterly contraction. In Q1 2024, investors closed 653 deals, reflecting robust early-year enthusiasm. However, by Q4, the number of deals had dropped to 351, suggesting that investors are now being more discerning in their allocation of capital. Despite this reduction in deal frequency, the total investment volume tells a contrasting story. In Q1 2024, crypto VC funding reached $2.7 billion, a figure that dipped in the second and third quarters. Yet, by the fourth quarter, the total investment volume experienced a rebound, climbing to $2.6 billion. This represents a 13% increase quarter-over-quarter, a trend that underscores a renewed focus on backing established teams and differentiated technologies even as the overall number of transactions declines. Analysts from PitchBook note that the rebound in funding is a clear indication that while the market is consolidating, investors continue to channel significant capital into high-potential projects. Year-over-year trends and historical context. When comparing annual figures, the level of VC activity in 2024 appears to be on par with that of 2023. However, both years fall short when measured against the record-breaking figures of 2022, during which both the deal count and deal values for crypto VC reached unprecedented levels. This historical perspective highlights that, despite the downturn in the number of deals this year, the market has maintained a robust level of investment activity, with a clear preference for quality over quantity. Sector breakdown. Web3 leads the charge. Within the diverse landscape of crypto VC investments, the Web3 sector emerged as the top recipient of venture capital in 2024. Encompassing decentralized communities, metaverse and gaming projects, NFT platforms, and AI-integrated crypto initiatives, Web3 attracted the highest level of funding. In Q4 alone, the sector secured more than $800 million in VC investments. A standout example in this space was Praxis, a project described as a utopic, artificial intelligence-friendly crypto city, which received a substantial funding pledge of $525 million on October 15. Over the course of 2024, the Web3 sector amassed a total of $2.1 billion in investments spread across 142 deals, the highest among all sectors. This robust activity underscores the growing investor confidence in decentralized technologies and the potential for these platforms to drive the next wave of digital innovation. Following closely behind, blockchain networks, which include critical infrastructure such as bridges, interoperability solutions, and both Layer 1 and Layer 2 networks, received $1.8 billion across 106 deals. This sector's performance indicates that there remains strong investor interest in the foundational technologies that underpin the broader crypto ecosystem. Infrastructure and developer tools also garnered significant attention, with investments totaling $1.7 billion in 125 deals. This category covers essential services such as data storage solutions, development platforms, institutional services, and node and validator management systems, all of which are crucial for maintaining and scaling blockchain operations. The access sector, which comprises asset management, exchanges, wallets, and research and data tools, secured $1 billion in funding over 70 deals. Meanwhile, decentralized finance, DeFi, attracted $714 million in 80 deals, highlighting continued innovation and investment in this rapidly evolving segment of the market. Investor selectivity and market implications. The divergence between the declining number of deals and the rebounding investment volume points to a broader trend of increased investor selectivity. As market conditions evolve, investors are increasingly inclined to support projects that demonstrate a clear competitive advantage, strong management teams, and innovative technology solutions. This shift toward high-value projects may indicate that the market is maturing, with a greater emphasis on long-term viability rather than rapid, high-frequency deal-making. PitchBook analysts have observed that the pullback in deal count, which became especially evident in Q3, is a sign that investors are exercising greater caution amid an environment characterized by rapid technological change and evolving regulatory frameworks, with capital being directed more strategically. The quality of projects receiving funding is expected to improve, potentially leading to more sustainable growth and innovation within the crypto space. Overall, the data from 2024 suggests that while the frequency of VC deals in the crypto sector has declined, the overall investment remains robust. This indicates a market that is not only weathering fluctuations but also adapting by prioritizing projects with strong fundamentals and long-term potential.